One for you day traders. In this video, we'll talk about be aware of the first 30 minutes of trading. Stick around. Hey guys, warm welcome to you. Thank you for joining me. Okay, so if you're day trading and we're talking about the open. So actually, even if you're trading currency, we're talking about the opening of the underlying stock market. So you're trading Euro, DAX, if you're trading GBP, FTSE, you're trading dollar, going to be the US markets like the Dow, the Nasdaq, etc., NYSE. But even if you're trading those actual indices, it's the first 30 minutes. Why have we got to be aware of it? So the open, I found, is either your best friend or your worst enemy. You're either got this great strategy that works very, very well at the open, you're good at reading the drives, you're good at reading this, and it really works for you, or it's a bit of a nemesis. You kind of look back on your results and you go, you know what? The open doesn't serve me. The open does not give me the opportunities that I want. I don't have the results. And that's you being objective and looking through your results and going, okay, hey, how am I getting on the open? Sometimes you kid yourself. Sometimes you go, you know what, I'm really good at the open. There's a lot of volatility. I want to get involved with it, get seduced by the action. And actually, when you look at your results, you go, my results aren't that good. I actually have to basically be, honest with myself and say, hey, the open's not serving me right now. It's something to work on, but at the moment in time, I need to be aware of it. Why do you need to be aware of it? So it's a lot of times, guys, you see very choppy action, and that's because there's a lot of algos fighting around. Liquidity on the book is thin. You know, if you think about the order book of the DAX or the FTSE or YM, Dow, ES, whatever you're trading, it's much thinner at the open, just purely because the participants have not involved in it yet. You know, the book's been maybe trading overnight thinly if we're looking at some sort of futures product. Then the open comes, it's a little bit thicker, but you've got a lot of market orders hitting the book, hitting the market, hitting the top side of the book or the bottom bit of the offer side of the book. You know, you've got a lot of market at open orders. You know, so people will place these market at open orders with their broker, and that will hit the market actually at the open. And also, if you think about from a stock perspective, a lot of market open orders hitting the stocks, and of course they are part of the constituents of the index. So if there's a lot of those happening, then the index is going to have to come into line. The arbitrage players are going to play against the actual whole basket of stocks. So there's a lot going on. And then you've got the margin calls. You've got people who are basically getting margin called out. They're like, hey, you know what? This is literally, again, will convert into a market open order. It's the broker just going, bang, get me out. So there's a lot going on. And combined with the lack of liquidity, the lack of thickness in the order book, can result in this kind of choppy environment. And we look at it as day traders and go, oh, it's really good, really good. But sometimes it can be hard to get a handle on it. But sometimes there's a sweet spot. So I think the way to attack the open is this, is to say, listen, you know what? Beware of the first 30 minutes of trading. And unless I see something very specific, don't get involved in it. Now, you could say 15 minutes if you think you can kind of want to get a handle on still opening drive, but let the first kind of 15 minutes oscillate around. You could be safer and go an hour. The point is, guys, the open is super volatile. There's a lot of stuff going on. However, you can start to say stuff like, okay, do you know what? At the open, under normal circumstances, I'm expecting just noise, right? I'm assuming it to be noise. However, under certain conditions, there may well be a good opening play to take. And you might have one or two opening plays. They might be an opening drive type play. In other words, we open up, we push and we hold, and you get an opening drive flag type play. Great. If you see that and all the attributes are there and you see the good drive and the strength, you take it, you put your stop here, fine. Another one might be the fake out type play. So you see the drive, you see a reversal, and then you kind of see it holding at lows and you go, well, actually, you know, it's reversing off that. Now, I'm just kind of giving you an idea and a framework, but the point is, rather than just getting sucked into the action and going, I'm going to find a trade in the action, you go, hey, I want to see a specific pattern, opening drive, opening reversal, and if I don't see that, I won't touch it. There's a distinct difference, and there's something I think a lot of day traders should consider, because the open can be very, very profitable under the right conditions, but most of the time it's going to be choppy. You know, when we don't get any gaps, when the market's not gapping up or down, you often get this. When it's a day we're waiting for data, you often get this. When we're getting good gaps, sometimes you get like drives for gap fills, sometimes you get partial gap fills and rallies. and when we're at fresh highs, when we're kind of right in the middle of the overnight range, you often get this. When we're about really near the high of the overnight range, we're going to get much more likely to be some range extension. So it's looking at being very wary of the first 30 minutes and going, okay, what's happening in the first 30 minutes? What am I expecting to happen? What is actually happening? And at what point will I decide to make a trade or not? Where's my cutoff point for saying, no, I'm not going to take a trade? Where's my cutoff point for saying, you know what, it's setting up, it's got an opening drive type play, yes, I will now look for an entry. And then so that the open then doesn't become a nemesis for you, it doesn't be something that kind of takes money from your account. It's a case of, yeah, you know what, when it's setting up, when my edge is there, then I can push the throttle down, then I can take a trade. Otherwise, I'll let people fight it out. I'll let the algos battle. I'll let the market open orders, the margin calls, the general noise fight it out, and I'll frame it and I'll say, right, what's going to happen after? Are we going to sit in a range? Do we start in a trend? Is there another trade setting up that I can get on board? Is that a continuation trade? Or is it, let me wait for it to peter out and wait for it to run out of steam and take a mean reversion play, and structuring and letting you be in control of when you trade rather than being sucked in just to market volatility. Anyway guys, that is beware of the first 30 minutes of trading. Take care, see you in the next one. Keep your risk managed, bye bye.